Okay, so I'm on record now. So what we are looking at today is CVP analysis. So by CVP analysis, I'm talking about cost, volume, profit analysis. And by this, I know we would have gone through the material here. It has to do with how cost, volume, and profit, how they interact. That is, what is the relationship between cost and volume? The relationship between cost and volume, and the impact on profit. That is the impact it has on profit. So, looking at this, you would have heard of the word cost. Right from maybe primary school days, you heard the word cost price. You would have heard of the word cost price. And so when you hear the word cost price, this cost price in the initial sense means total cost. So in essence, when you see this cost here, what I'm referring to is total cost. And what makes up total cost is the summation of total variable cost and total fixed cost. By total variable cost, we mean those costs that are expected to change with changes in the level of activity. The costs that are expected to change, we can take the notes little by little. The costs that are expected to change with changes in the level of activity. And so, under this total variable cost, the assumption there, or this what we are doing here, CVP analysis, here follows the marginal costing technique. It follows the approach of the marginal costing technique. And as such, if I want to say what are my variable costs, I'll be talking about materials, I'll talk about labor, I'll talk about other direct expenses. So when you start seeing all this in other topics like relevant costing, when you start seeing it in the concept of maybe transfer pricing, when you start seeing it in limiting factor, please, these are regarded as variable costs. So the assumption under marginal costing technique that the CVP analysis follow is that material, labor, and other direct expenses are regarded as variable costs. When we get to other technique like the modern management accounting technique, some of these elements may not be termed or will not be termed as variable costs. They will be termed as fixed costs. So let's know the assumption that this falls under. So by fixed costs, we mean those costs that are expected to remain the same even with changes in the level of activity. When I say changes in level of activity, I mean changes in activity such as volume of production, volume of sales. So if you want to remember fixed costs, you can term like examples like rent. If I own a factory and I rent the factory space, maybe annually I'm expected to pay 10 million for the rent. And then at the year end, I discovered that instead of me producing 20 million products, due to COVID-19, I was only able to produce 10 million. I will not go to the landlord and say, landlord, you know, as per our production capacity. We are supposed to produce 20 million. But see this COVID-19, we produce only 10 million. Because of that, this your 10 million rent. Please, can you, for the next year, can you please collect just 8 million from us? The landlord will not agree. So whether you produce 10 million or you produce 50 million, the rent is still 10 million to be paid. That's what we can classify to be fixed cost. And it's just like salaries of workers too, like those that are permanent staff, administrative staff, that your organization sells less does not mean the MD will come to you and say, because we did not make much sales this month, okay, your salary that is 500,000, and let's just make it this month for 400,000. It does not happen that way. So that's what we can term as fixed cost. So if you are looking at total variable cost plus total fixed cost to be our total cost, we look at it that this total variable cost is coming from variable cost per unit multiplied by the level of activity, which is representing our volume of production or volume of sales. Total fixed cost is coming from fixed cost per unit multiplied by the level of activity. But one thing we should also note is that please always try to differentiate between when the examiner is telling you about total. When the examiner is telling you about total and when they are telling you about per unit. And you should always pay attention to this detail in the exam. Always pay attention to this detail in the exam. Why? When the examiner is telling you calculate total and you are doing per unit, you are on your own. So you should be able to differentiate the total from the per unit value. In the exam too, this what we call this total cost. In the exam, you will always see something. I don't know if you have seen question where the examiner will tell you, calculate the unit cost. What they are trying to tell you to calculate there is the total cost per unit. That is unit cost. They are not telling you to calculate total cost. So when you are dealing with unit cost, you mean per single product. Please, let's always pay attention to details as regards that. So under CVP analysis, what it informs me is that I must know the origin of this, that my total cost is coming from total variable cost plus total fixed cost. Then I must be able to play with this formula interchangeably. That's how I can know the relationship between them. In essence, it leads me to say that given this, I can go on to say my total variable cost is equal to my total cost minus total fixed cost. And my total fixed cost is also my total cost minus total variable cost. Why do I need to know this? In case if I'm in the exam and the examiner gave me variables where I could not find this and I need to calculate this, or where I cannot find one variable, I cannot find total fixed cost, and I need to calculate total fixed cost where I cannot find another variable, what will I do? So that's the reason why you must know how all these formulas, how they come to play. So that's that on the cost aspect. On the volume aspect, we are talking about units of production. Unit of production, units of sales, or sales volume. And it is usually represented by the variable Q. Sometimes you see in most textbooks Q, sometimes they will use X. That's to denote the unit that was produced and sold. When you get to other topics like limiting factor, you'll be hearing the word unit produced and sold, annual demand, maximum demand. All these are a representation of this X, or what we can term Q. They are representation of the volume of what activity. Are you with me? Hello, are you with me?
Yes, sir.
All right.
Yes, we are with you.
So the third one, profit. We have talked about cost, we have talked about volume, now we are on profit. When we were in primary school, our examiner will say profit, which I denote with this symbol, is equal to selling price minus cost price. Were they right? Yes. they were very correct. That is because they follow a particular school of thought. Now, because we are on CVP analysis, and in performance management, the major emphasis on profit is always according to the marginal costing technique. Is always according to the marginal costing technique. The major emphasis on profit is always according to the approach of the marginal costing technique. And before we can talk about profit under the marginal costing technique, we will first go to a man. There's a man who we call contribution. This man usually forms the central point of most of the topic in performance management. In fact, even up to the day of the exam, most people usually forget the formula. They usually forget the formula. So when we talk about contribution, contribution is the value that a product contributes to profit. The numerical value that a product adds. Let me use the word add. I should not repeat the same word. The numerical value that a product adds or gives to profit. And contribution mathematically contribution is equal to selling price minus variable cost. Contribution is equal to selling price minus variable cost. In essence, my definition here is what? When I'm talking about contribution per unit, it means selling price minus variable cost per unit. So if the examiner requires you to do anything that has to do with total contribution, and that's why I said the per unit value and the total value, you must be able to differentiate. Total contribution is sales, or what I call total sales minus total variable cost. Total sales minus total variable cost. This formula, please, let it always be something you remember all the time. Before I now proceed, after this contribution, there's something we call CMR. Because of other subtopics we'll meet along the way, I will not do without discussing this. CMR. And CMR stands for contribution margin ratio. Or we call it PVR. Profit volume ratio. We also call it CS ratio, which is contribution to sales ratio. So let it be noted that the examiner can use any of these. If the examiner chooses to use this, fine. If they choose to use it, fine. If they choose to use it, fine. So you should be able to know that that's the three ways in which the examiner can refer to it. CMR is a ratio that is calculated as the ratio of contribution to sales. Or we can say contribution per unit all over selling price. That's how we calculate our CMR. You will see the importance of this ratio later. Now, because in CVP analysis, we must know how all these variables, how they connect or how they relate. I can also say that my CMR is selling price minus variable cost all over selling price. Here my SP minus VC is equal to contribution. So it replaces this here. That's why I said you must know how they relate. You must know how they relate. Having known that, I will go on to now say that my profit, according to the marginal costing technique, is contribution minus fixed cost. Profit equals contribution minus fixed cost. Now, let's play with formulas again. Recall that contribution is equal to selling price minus variable costs. And fixed cost is equal to total cost minus total variable cost. In essence, I can say that my profit is equal to SP minus VC minus into bracket TC minus TVC. This gives me SP minus VC minus TC plus TVC. Recall that when I mention VC, or let me change it to VC minus VC, that is plus VC. Let me change it VC, but we know what I mean there. This one cancel this. Profit is equal to selling price minus total cost. Recall that total cost is equal to cost price. So it takes me to the beginning, which says that what? Profit is equal to selling price minus cost price. So can you see where the marginal costing technique derived their own from? You see now that when I said what they told us then in secondary or primary school is correct, you see that it takes us back to this. So in essence, I've been able to explain the concept of cost, its relationship with volume, and then the impact on profit, how these three interact. Under CVP analysis, it should also be noted that in defining this, where I said total cost is total fixed cost plus total variable cost, that using a linear regression, we can also define it, in case you see it in the exam. It was one of the things that was used in a particular diet. Y equals A plus B X, where Y is total cost, A is total fixed cost, B is variable cost per unit, and X is the volume of activity. And it should be noted that my BX here, this BX as a whole, represents my total variable cost. It represents my total variable cost. Next one. Break-even analysis. When we talk about break-even analysis, it takes us to the concept of break-even point. And the break-even point for any organization is the point at which profit is the point at which profit is zero, or the point at which total contribution is equal to total fixed cost. Is the point at which profit is zero, where total contribution is equal to total fixed cost. That means your total fixed cost used up all the total contribution. And at that point, we call it the break-even point. Now, this break-even point, there are two methods of calculating break-even points. We can refer to break-even points to be in units, or break-even points to be in sales value. When it is in sales value, we are referring to like the denomination, or the currency in which the firm or the organization trades. So by break-even points in units, we calculate that as our total fixed cost all over contribution per unit. total fixed cost all over contribution per unit. And break-even point in sales value is equal to total fixed cost all over CMR. Recall that CMR is contribution all over what? Selling price. Where you are not giving selling price and you are giving total sales, your CMR is total contribution over the total sales. That's why I said you must know the difference between the per unit value and the total value. Okay. Let's say Light Limited produces and sells a single product. Forecast data for 2023 as follows. We have the revenue in units, 8,000. We have sales price per unit to be 30 naira. We have variable costs per unit to be 16 naira. Annual period cost are estimated at 50,000 naira. What is the break-even point? In units and sales value. Break-even point in units. First of all, you state your formula, total fixed cost over contribution per unit. So, where our total fixed cost is what is defined as annual period cost here. So, another name for total fixed cost is period cost. Let's take note of that. Another name for fixed cost is period cost. Total fixed cost is 50,000. Contribution is not given, but we know it is selling price minus variable cost, which is equal to what? Our sales price per unit of 30 minus our variable cost of 16. That gives us what? 14. Am I right? It gives us 14. So, having known this, our BEP in units is 50,000 divided by 14 naira. What does that give us? Can someone help us here? Help us here. Hello, are you with your calculator? Hello, please let's talk. Let's make it interactive. What you can do for me is just to be with your calculator, you punch. You are free to talk, just unmute and call the number. You don't need to put it on the chat box. You can unmute and talk. So 3571 units.
3571 units.
Thank you. The break-even point in sales value is total fixed cost all over CMR. We know our total fixed cost, but our CMR is defined as our contribution all over selling price. And we know our contribution to be 14 naira per unit, and our selling price is 30 naira. So what does that give us? 14 divided by 30. Let's someone quickly punch.
0.466.
0.466.
Yeah.
466, okay?
Yeah.
So that means our BEP in sales value will be 50,000 divided by 0.466. What does that give you?
$107,296.
107,296.
296.
That's 107,296.
Yeah, 296.
Another way we can calculate this is to say that our BEP in units multiplied by the selling price. Please do that. What will it give you? 3571 multiplied by 30.
$112,530.
112
112,530.
530. So what could be the cost of the difference? Okay, 107,130. Okay, the cost of the difference is as a result of approximation from the CMR.
Yes.
Is as a result of approximation from the CMR. If you notice, once you calculate your CMR, the numbers after the decimal will extend.
Yes.
So it does not give us an actual value. So
yes.
Because of that, in questions like this, the examiner can tell you to the number of decimal places you have to do it.
Yes.
Or better still, to be on a safe side, when you are required to do anything that has to do with BEP in sales value, just multiply it by the selling price direct and use that value. Except otherwise stated where the examiner just say maybe your CMR should be to 2 decimal places, or 3 decimal places or 4 decimal places. So the roundup is as a result of the ratio. That is, we use 0.466. If you use 0.4666, there will still be changes in it too. So it's as a result of the decimal places. Is it clear?
Yes, sir.
Margin of safety. When we talk about margin of safety indicates by how much sales may decrease before a company will suffer a loss. By how much sales may decrease before a company will suffer a loss. And it is represented just like your BP, you can be represented in units and sales value. So MOS in units is budgeted sales units minus break-even point in units. And MOS in sales value is budgeted sales in Naira or whatever currency you are giving minus break-even point in sales value. Minus break-even point in sales value. Let's say Airlight Limited product has the following costs and selling price structure. On unit basis. We have selling price 64. We have variable cost 34. We have fixed cost to be 10. Now my question is, what will be in this total? Based on my explanation so far, what will be in this total? Oh yeah, let's talk. Hope you are not in the class by proxy. Let's talk. What will be in that total? I was about to sum something now. What will be in the total value? I want to know if you truly understand what I've been explaining so far. I've seen a past question on limiting factor whereby they did something like this and they didn't give them the total because the examiner knows if the examiner knows that if he or she puts the number there, people will get it. So they actually use that as a way to draw people down. You are giving selling price there, you are giving variable cost, and you are giving fixed cost. As I said earlier on, I said CVP analysis has to do with how these variables, how they relate. So when you see selling price, you saw variable cost and you saw fixed cost. If I give you this as a total, what does this 20 represent?
Contribution margin.
What do you say?
Contribution margin.
No, you are wrong.
Total cost.
What did you say?
Total cost.
No, you are wrong. This selling price. This variable cost. This fixed cost. Then I come to the total here and I wrote 20. This 20 is profit. Do we understand it, or I should explain it? Do we understand, or should I explain?
Can you explain further?
You have selling price. What's selling price minus variable cost? What's the relationship between selling price and variable cost? Selling price minus variable cost. Contribution 64 minus 34, 30. 30 minus 10, 20. Is it clear?
Yes.
All right, let's continue. Budgeted activity is 1,050 units per month. Required. What is the budgeted margin of safety in units and sales value?
Above it.
What is the budgeted margin of safety in units and sales value? MOS in units. We call that MOS in units is equal to budgeted units minus break-even point in units. Here our budgeted units is equal to 1,050 units. And our break-even point in units is total fixed cost all over contribution. Recall that in the question, what you are given is fixed cost per unit of 10 naira. Fixed cost per unit is equal to 10 naira. Our total fixed cost will be 10 naira multiplied by 1,050 units. This will give us 10.5. So BEP in units is equal to total fixed cost of 10.5 divided by contribution per unit of, and our contribution, what's our contribution? Selling price minus variable cost, 64 minus 34. Please, when it comes to PM, I don't know of any other paper, always indicate your unit of measurement. If it is unit, put unit. If it is naira, put naira. If you fail to do so, the examiner will mark it down for you. So when you are calculating BEP in units and you just wrote 1,000, instead of you to say 1,000 units, the examiner will just be asking himself, is this person trying to say 1,000 naira or 1,000 units? So this is 10.5 over 30 naira. When we divide, this will give us 350 units. So MOS in units will be 1,050 units minus 350 units. This will give us 700 units. Our MOS in units will be 700 units. MOS in sales value, in short form, will be MOS in units multiplied by the selling price. Which is equal to 700 units multiplied by 64. Please, 700 multiplied by 64. Quickly give me the answer. 700 multiplied by 64. Let someone do the calculation. Also, in case if the examiner requires to calculate margin of safety ratio, it is given as MOS in units all over budgeted sales units times 100, or MOS in sales value. You are not going to calculate that. I'm just giving you as an insight. Budgeted sales value times 100%. Please, what's the value of that MOS sales value? MOS sales value. Please use your calculator. Who is there?
44,800.
44,800. Thank you. Let's proceed. The concept of target profit. Every organization exists to make profits. That's their aim. To sell goods to customers or services to customers with a view to make profits. So every organization aims to make profits. And for them to make profits, in a financial year, they will usually have what is called a budget. It's only an unserious organization that does not have a budget. So every organization must make a budget that will serve as a guide to that objective, to the objective of making that target profit. Now, for them to make a particular profit or a profit target in a particular financial year, the management of the organization needs to know the amount of product they will need to sell in order to make that profit, that targeted profit. In essence, this targeted profit now leads us to what is called target volume. And this target volume can be expressed in units and also in sales value. So in the exam, if you have seen something in the exam before, for those of us that we have been having issue with performance management, passing it, you have heard of something, they will say advice management on the quantity of products or goods that they must sell. What they are trying to tell is the target volume. Or advice management on the quantity of products they must sell to make a profit of 100 million. What they are trying to tell you to calculate is target volume. Now, target volume in units is trying to tell us the number of units we must sell to achieve that target profit. Then target volume in sales value. What we are following, I expect someone to have corrected this if you are looking at the board. Target volume in sales value, it means how much sales we must make in order to achieve the target profit. Target volume in units is calculated as total fixed cost plus target profit. All over contribution per unit. Target Target volume in sales value is calculated as total fixed cost plus target profit. All over CMR. We know what our CMR stands for. Hello, can you all hear me? Please, the previous question, did you write it down? Did you write the previous question down?
Yes.
Okay. You will give me the figures because I will need to do like a switch over. You give me the figures. Illustration. Let's say using the previous information, using the previous information based on the previous illustration, calculate the number of units that must be sold to achieve a profit of 45,000 in a month. What's the examiner? What are they trying to say here? Calculate the target volume that you need to sell to achieve this target profit of 45,000 in a month. So target volume in units is what is required, which is total fixed cost plus target profits all over contribution per unit. Our total fixed cost from the previous example was what? What's the total fixed cost? What's our total fixed cost?
$10,500.
Not 10,500. 10,500 was it 10,500?
The
Yes.
total fixed cost PFC, yes.
Okay, 10,500. Target profit 45,000. Contribution per unit. What's the contribution per unit that we got?
30 naira.
30 naira. Please add everything. This should be 5,500 if I'm right. Please, you see as I'm indicating with symbols with the unit of measurement. Please, in your exam, always do the same thing. You might be looking at it that you scored less in PM. Maybe you've written it before. These are part of what results to that. You don't just say 10,500, 45,000. You must always put the unit of measurement. All over 13 naira. Please give me the final figure. The final figure will be in units. Oh yeah, now.
1,683.
1,683 units.
Dot 333.
Well, let's
Yeah.
put it as 1,683. So this is units that must be produced and sold to achieve a target profit of 45,000 naira in a month. Any question based on what I've done so far? Any question? If there's no question, let's say no question. Now we know there's no question, I can move on. Are you all with me? Is Oluchi there? Olawale Sunday, Yusuf, Oluwasheu. I don't know the name
I'm
of
here.
the person.
Oluchi is here.
Okay.
Oluchi is here.
Please, everything I've been doing so far, is it clear to you? Or there are confusions?
No, I joined the class very late. I joined by past 1, so I'm trying to catch up.
Okay, but you're able to write the things on the board, right?
Yes.
Okay, good. What about Yusuf? What about Olamide?
Yes, I'm here.
Hope it's going well.
Yes, no question.
Adeyemi Michael, hope it's going well. Please don't pretend though, don't pretend to understand. Don't pretend to understand. We want you to clear your ICAN paper so that we can come and eat rice on your induction. So you can invite us, we eat rice on your induction. Not the ICAN rice, but the one you will cook. You know ICAN will cook their own rice. The one you will cook, that's the one we want to eat. All right, let's proceed. There's a question down already for us in PDF format, which after the class, I will tell the coordinator to forward to us for us to attend. I want to see our skills in our skills in applying everything that we have learned so far in solving that question. One thing you can do for me is that the secret to PM, number one of the major secrets to PM that I've discovered so far, even on the part of those that are even older, is obedience. Once you are able to obey, number one secret, part of the secret is that obedience. Once you are able to follow the instruction or the instructions of whoever is taking you, you are 50% good to go. And I usually tell people, no matter how big you are, you're in any organization, once you have your instructor or the person, your lecturer taking you, giving you instruction on what to do, just do it. So if I tell you solve this question, you might not get it perfectly, but in essence, you're already building yourself in a way to be able to pay attention to questions that might come out in the exam, the way questions might come out in the exam, and the way to attempt it. So most of them, when you give them this question now, they will not attempt it, they will not even make any attempt. By so doing, you are not helping yourself because you are not trying to build confidence. What I'm trying to let you build by giving you that question to solve, which I expect everybody to solve it, and then you will now ask multiple questions when next we meet. Before we go to the next topic, which I will take you also on the limiting factor. Please do well to solve that question. Make all your attempts, make all the errors you want to make, so that when you now get the final solution, it will be an eye-opener. So further illustration, we can write this. 37.6. So assuming stability in prices with variable costs, carefully controlled to reflect predetermined relationships and an unvarying figure for fixed cost. That is, we are saying fixed cost does not change. Fixed cost remains the same. The selling price per unit is 1 naira required. Calculate A, the total period cost. B, profit volume ratio. C, the break even point in units and sales value. D, margin of safety for year 1 and 2. All right. Whenever you are giving information relating to total costs and sales value, you are giving information relating to total costs and sales value at different levels or for different periods, just as we have here. In this example here, we're only having for 2 years or 2 levels. The examiner can give you up to 5 or 10. You have the values of all these elements of total sales, total cost for 2 levels, 2 or more levels. The approach to it is what we call high-low method. We use the high-low method to approach this. And how do we go about the high-low method? Step 1. From the variables given, indicate the highest out of all values for your total sales and total cost. You can pick any of them and start with, knowing fully well that your sales and your costs go in the same proportion. Your sales cannot be increasing and your costs will be reducing. What I'm talking about here is the cost relating to production. As you are earning more revenue, your total cost too will be increasing. But it might not be in the same exact proportion as total revenue. It might be maybe slightly lower, depending on how you are able to manage costs, how you're able to manage or minimize costs. So I'll come here, I'll say highest, lowest. My highest can be found in what year? Let me put it with respect to sales, total sales in units. My highest is in year 2, where I have 43,000 units, and lowest is in year 1, 39,000 units. So sales in units, and then this total cost is in naira. So 43,000 as the highest, year 2, and year 1, 39,000. In that same proportion, the total cost reacted to it by saying 37,600 and 34,800. 37,600 and 34,800. The next step is to find the difference between these two. Find the difference between the highest and the lowest. So 43,000 minus 39,000, this will give us 4,000 here. And 37,600 minus 34,800, this should give us, please, you can help me with that. This 8. Two 8s. The next step is to find the variable cost per unit. And the variable cost per unit is a change in the total cost all over change in total sales, which is 2,800 divided by 4,000. 4,000 units. This will give us, please help me calculate this. Hello? Please, let's always be at alert with our calculator. It makes the class go fast. And you'll be able to follow well. Okay, do I have Olamide, can you help with that? Or
0.7.
0.7, that's 0.7 naira per unit.
Yes.
So that means we are able to know what our variable cost per unit is. Then we'll go on to say, recall that total cost is total fixed cost plus total variable cost. We want to go on to calculate our total fixed cost now, based on the text requirement there, which is to calculate the total period cost. So 1, total period cost. And this total cost, which is equal to total fixed cost plus total variable cost, I can define it also as y equals a plus b into bracket x. So I will now say, using any of the information in year 1 or year 2. You can use any one. Let me use year 2. If I'm using year 2, at year 2, my total sales in units was 43,000 and my total cost was 37,600. So I will say, let me use the information in year 2. Total cost was what? 37,600. Knowing fully well that total cost is equal to total fixed cost plus total variable cost. So I'll say 37,600 is equal to total fixed cost plus what makes up my variable cost? Variable cost per unit of 0.7 multiplied by the volume of